Markets opened July with a December hike as the base case and spent 5 trading sessions unlearning and relearning it. A 5-7K payrolls print bled the tightening bets out of the strip. A reshot Strait of Hormuz is pushing them back in. Wednesday's minutes from the June Federal Open Market Committee FOMC meeting landed mid-round trip, describing a world that had already stopped existing. The Federal Reserve Fed did not misfire. This is the operating system Kevin Warsh installed on June 17th, running as designed, 5 sessions to report. The Bureau of Labor Statistics (BLS) opened the sequence last Thursday with June non-farm payrolls NFP at 57,000 against a consensus near 115K. May was cut to 1-9K from 172K, and the 2 prior months lost a combined 74K to revisions. The unemployment rate fell to 4.2%, and for the wrong reason, participation dropped to 61.5%, its lowest since March 2021, as roughly 720K people left the labor force in a single month. Average hourly earnings rose 3.5% YoY against headline inflation above 4%. Real pay is still shrinking. The strip did what the data said. A September hike came off the table, October stayed penciled, and the sell side spent the long weekend capitulating to the peace trade. The U.S. Energy Information Administration cut $27 from its third quarter. Brent forecast and Saudi Arabia cut official selling prices by the most in 2 decades. Within 2 sessions, the trade they were chasing was gone. Washington revoked Iran's oil export license on Tuesday. 3 tankers were hit in the Strait of Hormuz, and by Wednesday, President Donald Trump was declaring the ceasefire over Brent traded through $80 at the highs as the front spread flipped from contango to backwardation, and tanker traffic through the strait all but stopped. That is the war's allotted space in this note, because for rate purposes only, one line matters. The single largest input into the next run of inflation prints is again being set by ordnance. The July contract tells it in miniature. Its hike tail ran to 40% in late June, was cut to 20% by the payrolls print, and has rearmed to 30% per CME FedWatch, leaving the hold near 70%. With money markets still carrying at least 1 to 5 BP hike this year. 9 dots walked in. A few walked out. The June summary of economic projections (CEP) showed 9 of 18 dots penciling in at least one 2026 hike. The lurch that made December a live contract. The minutes of the same meeting describe only a few participants judging that another hike could eventually become appropriate. In the Fed's counting lexicon, a few sits near the bottom of the ladder. 9 of 18 would ordinarily earn an about half. Somewhere between the dot plot and the prose, the hawk block shrank. There are 2 ways to read the gap, and neither is comfortable. Either the dots are scenarios rather than convictions, penciled sketches of a path nobody will argue for on the record, or the last detailed account of the committee's thinking is itself being managed down under a chair who struck forward guidance and withheld his own dot. The minutes are no longer a postscript, and even they read softer than the projections they accompany. The arithmetic makes it worse. Dots are anonymous across the full set of participants, but only 12 members vote. And June's hold at 3.50% to 3.75% past 12 to 0. The hawkish case exists in projections and in what Walsh called a family fight, nowhere yet in a dissent. The sharpest detail is that the camps are largely the same people. The record sketches paths where inflation fades and lower rates follow, alongside paths where the war tariffs and AI demand keep prices elevated, and firming follows. At 10:09 p.m., one committee carries two opposite reaction functions and outsources the choice to the data. A December hike buyer is pricing a coalition that has never shown up on a ballot. The record is shrinking on every page. The statement went first. Cut to roughly 130 words from about 310 and stripped of forward guidance along with its easing bias. The minutes confirm the committee signed off. A majority of participants saw advantages in the shorter statement, and a number called it an opportune moment to rethink the format altogether. This is a regime with buy-in, not a new chair's whim, and regimes outlast their authors. The minutes themselves ran shorter than usual, and the 5 task forces Walsh unveiled at the podium, covering communications, the balance sheet, data sources, productivity, and the inflation framework, earned barely a line of recorded discussion. Add the floated idea of press conferences held only when the Fed has something to say, and every channel is narrowing at once. Since the debut presser, Walsh has made one public appearance at Sintra, warning that nobody should expect his Fed to be comfortable with inflation above 2%. One sentence from one podium currently carries the entire reaction function. Minutes for a world that no longer exists. Read closely. The June record rests on 2 assumptions that died before it printed. Its labor read predates the 57K print, the revisions, and the participation slide. Its inflation path leans on pump prices falling and on supply disruptions from a shut Hormuz diminishing, and that conditional inverted before the document was a day old. What survives the staleness is the part the market has barely priced. The staff revised inflation higher for both 2026 and 2027, with participants flagging the war, tariffs, and AI-related investment as the persistence channels, an admission that price pressure should outlast the war premium itself. That is the downstream pass-through these pages argued after the debut presser. Fertilizer and feedstock costs grinding into food on a planting to harvest lag, and round 2 of the shock lands on a complex that never normalized from round 1. The AI line deserves its own beat because it decides which scenario wins. Participants see the build-out sustaining price pressure on technology products and electricity now. Walsh has publicly planted himself in the productivity camp, where AI is net disinflationary eventually. If the chair discounts the one domestic inflation driver his committee flags as current, the burden of proof for a hike quietly rises, whatever the dots say. The patience clock. Sitting over all of it is the man who made the appointment. Trump picked Walsh expressly to deliver cuts, called the no-cut debut fine, and has now personally rearmed the December contract by declaring the ceasefire dead, his own escalation feeding straight back into his own borrowing costs. That patience has never been tested by a war premium with his name on it. Every print now trades twice. The next test is Tuesday. June Consumer Price Index CPI data lands July 14th at 12:30 GMT and covers the peace dividend month when pump prices were falling, so a soft headline is close to baked, and the market then has to decide what a backward-looking print is worth against crude up roughly 10% inside a week. The Producer Price Index PPI follows on July 15th with retail sales on July 16th. And the FOMC sits July 28th to 29th with no SEP attached and no guarantee of a podium, given the chair's preference for speaking only when there is something to say. The lean is to stop trading the level of December pricing and start trading its range. Terminal conviction has died twice in 3 weeks, once on a payrolls print and once on a tanker attack, and a hold through December consensus is one hot expectations print, or one more week of a shut straight from the same fate. 10:09 p.m. in a no-guidance regime, every print trades twice, once on the number and once on its reconciliation with the live tape, so a soft June CPI into $80 crude is a fade rather than a trend. Walsh built the regime so markets would trade the data instead of the Fed. And for 5 sessions, markets have obliged, except the input that mattered was measured in sorties, not basis points. The committee has written down 2 futures and told the tape to pick one. The tape is currently picking both, twice a week. Score, 8 description. Welcome back to your channel name, your daily source for Forex market news and analysis. Here's what's moving the markets right now. Markets reopened after the long weekend to a whipsaw that erased and then rebuilt rate hike bets in just 5 sessions. A weak June payrolls report, with only 57,000 jobs added against expectations of 115,000, took a December hike off the table. But within 2 days, a reshut Strait of Hormuz and revoked Iranian oil export licenses sent Brent crude above $80. Flipping the front spread into backwardation and pushing a hike tailback toward 30%. Meanwhile, the June Federal Open Market Committee minutes landed mid-round trip, describing a world that had already changed. The record showed only a few participants judging another hike could become appropriate. Far softer than the 9 of 18 dots that penciled in at least one move in the summary of economic projections. This gap suggests the hawkish case exists more in projections than in any serious dissent, and the committee has effectively outsourced the choice to incoming data. The next test comes Tuesday with June Consumer Price Index data, which covers a month when pump prices fell, so a soft headline is nearly baked in. But with crude up roughly 10% in a week, markets now have to decide what a backward-looking inflation print is worth against a live war premium. In a no-guidance regime, every print trades twice, once on the number and once on its reconciliation with the tape. That's today's market update. Follow for daily Forex insights, and we'll see you in the next one.